and welcome to another exciting episode in Federal Individual Tax ACNT 1331 with your hostess of the mostest, Professor Naragon. We're going to bring you the latest hits of business income, bringing you the classic of the Schedule C. Now, when we're dealing with Schedule C, there's going to be certain things that we would want to know out of this chapter. And this is not limited, but we do want to kind of understand the basics of the Schedule C. What is it? Where it comes from? All that jazz. The understanding of the tax treatment of inventories and cost of goods sold. Identify requirements for deducting transportation, travel meals, and business and education expenses. So there's a lot of fun little nuances there that IRS loves to gauge. And determine deductions for dues, subscriptions, and business gifts. Identify the requirements for claiming bad debt deductions. And the two really a little bit harder ones, home office and hobby losses. So I actually really do like Schedule C. And if you're in the mode to start your own business and put this on the tax return, this is something that you're going to have to use, or with any clients that you may end up having that have a small business. Schedule C is mostly used for sole proprietorships. Again, can never say that word very well, but they're going to be working with a lot of those. The ones that have it but cannot do certain things. Now, again, just like before, you're going to see me switch from the book and from the PowerPoint, kind of give y'all a little bit more in this video as we go on, especially if I do want to kind of highlight certain things. Now, when we're looking at Schedule C, this actually defines it as a trade or business. But the IRS really doesn't put specifically what a trade or business is. Mostly, the accepted principle is that it's any activity that is conducted for a profit. Okay, you want to be getting money and make money. So, this is where we're going to get into hobbies versus businesses in a sec. Closer to the end of the chapter, but that's one thing. For deductions, to be considered deductible, it has to follow basically three tests. One is to be ordinary and necessary, something that's actually legit in the business, have a legitimate business purpose, and be reasonable in the light of fees that are generated as a result of expenses. Now with those, I actually like how the book has it. So again, the book will define these items, and it's always good to kind of just look at it. In fact, I actually do love this book in a way that it is more simplification. Now, again, ordinary and necessary tests, they are supposed to be helpful and appropriate in running the business. So their example right here is Rob. He is a CPA, and he goes to tax boot camp, which offers intensive training on tax return preparation. Now, if you're a tax accountant, this is something that you actually have to do. Okay, always gotta know the new laws. Gotta know everything. So the thing is, with this, the cost of the tax boot camp would be deductible. But he also hires a trainer in a local gym. Now that's not part of a tax business. It's not really going to be common or ordinary in CPA firms. So you're going to have to look at what a business will typically have. Most CPAs are not going to have a personal trainer, so that will not be deductible. Okay? I know they're going to try and fight that, but it's not deductible in the eyes of the IRS. The business purpose test. Again, expenses must have a legitimate business purpose to be considered deductible. We got an example of Larry. Larry is an independent consultant who maintains an office in his home. Although he always meets his clients at their place of business, he spent $75,000 upgrading his office. Oh my God! Alright, to include a large attached glass sunroom and display area of his orchard collection. Where are they coming with this example? But this home office would probably really not even be considered a deduction because, one, it has no purpose for the business. Now, if he upgraded to at least include a bathroom, probably, I would probably more relate to that as a business purpose. But this is a home office, so and I mean doing that. I mean, a large glass sunroom. Wow, they really came with that that example there, right? But you gotta make sure it serves a purpose. Okay, serves a purpose for the business and has to be legit, and it can't just say, "Oh, I just need a place to relax." That don't work. So, but hey, he made some good money. Make $75,000 upgrade. I have to say that. All right, reasonable test. Okay, the last test that we tend to check for is that deductions have to be reasonable. In the book example, they bring us Derek, who does own a small business, and he takes one of his clients, who happens to be a friend, which is kind of a no-no already, but to expensive business dinners every week. Now, they have a variety of wines. They spend talks about their joint venture. So they're trying to make it a business meeting, but the yearly cost of these meetings and meals is about 20 grand. And Derek only generates 15,000 of fees from his friend. So he's spending a lot more than what he's actually getting from this friend. But because this is so lavish and extravagant, and also because it's his friend, the IRS is going to look at this, if they check on it, and will consider this as a non-deductible item because it's just too out there. It's not reasonable. Why would you take every week a client to wines and go over and beyond to a point where it's over what you get from him in revenue? They don't see it eye to eye, so they would actually deny that deduction. Now, if it was, like in their example, just for pizza and a business discussion every week, the expense would be more considered reasonable because, one, that's really what it is. You're meeting your friend. You're just happening to try to write it off as a business. So pizza and having the business discussion, yeah, that's more reasonable. But spending, man, that's just, I mean, whoa. But IRS is going to look at this, but as you can see, there's a lot of items that we're going to get into. The code does restrict deductions of certain expenses that are business related a lot of times, so they are kind of permissive in a lot of ways that we can deduct, but like personal living and family expenses, those you can't do on Schedule C, especially when trying to relate them to business. They're going to be mostly going to hit itemized deductions, which is Schedule A, and we're going to hit that in Chapter 5. Some capital expenditures, they're going to basically restrict tax exempt income. That's hard because if it's already tax exempt, they're not going to let you take expenses related to it. Sometimes are really just up to the amount of income that was to it, and of course all the legaling stuff. And I mean, some things are basically right here in your PowerPoint, like bribes, kickback, fines, penalties. You're not allowed to deduct. You can't deduct anything that's really illegal on the business. And lobbying expenses, anything political, you're not allowed to deduct. Sorry, but if you donate a lot of money to somebody's campaign, well, congratulations, you're not deducting any of that. That's just out of your goodness of your heart. So there is some things that we do basically have to watch out for that are excluded, but mostly with the IRS, they are very good at letting us know that we can't use those. Or you take a class and I tell you you can't use them. So cannot use bribes, kickbacks, fines, penalties, lobbying, anything political you can't do. Learn that very much. Okay. So the next thing that we get to see is there's actually two types of Schedule Cs. There's one known as the Schedule C, as anybody knows, and if you use any software, you're going to end up seeing that form. And then there's the Schedule CEZ. This is really a short form, and it is simplistic, and it kind of reminds you a lot of the 1040 EZ back in the day. Now it's gone. The thing I see with Schedule CEZ is that it's probably also going to be missing soon, as the government's going to try and make it all universal. So if you are going to go into tax business and you're going to be a tax preparer, just do a Schedule C for everybody. It helps out in the long run, and you don't have to get confusion. So I'm going to again go to the book. As you can see, the PowerPoint's referencing certain figures, and this is basically going to be illustrating different sections of the Schedule C, which of course I want to explain. But there is 5 parts, awesome stuff, but you're going to end up seeing what qualifications you have to do to file an EZ form, and there's a lot of qualifications. So let's go back to your book, back to the book, back to the book, back to the book, and let's look. So here's our qualifications already that has to be met to file a Schedule EZ. Okay, 1. The business expenses must be less than $5,000. Okay, if your expenses are more than $5,000, well, congratulations, you can't do an EZ. Okay, you must have no inventory. So if you're a merchandise company, you do have inventory at the end, you are not allowed to do the EZ. Business must not have a net loss for the year. So EZ, you cannot do the deduction for a net loss. It has to have an income. Okay, taxpayer must have only one business and a sole proprietor. Okay, so again, one business. Business must have no employees during the year. Taxpayer must not be required to complete Form 456-2 to report depreciation. So you can't have fixed assets. Cannot have the home office. Okay. Must not have disallowed passive losses in prior years. Basically, that's rental. Again, we're going to get into that one later. And the business must use the cash method of accounting. Okay. Now, cash method is basically we only record stuff when we receive the cash. There's another method called the accrual method, and that's with accounts receivable and accounts payable, where we either have people owe us or people that we owe that we haven't paid at the end of the year, so they actually get moved forward. Okay, so EZ, there's a lot, and guess what? Most people don't qualify for it. That's why I'm telling you, just go ahead and go with the Schedule C. But of course, if you're taking a quiz or exam, you may have a few questions on this, so don't forget. And if any client actually goes, hey, can I file a Schedule EZ? You're going to look at them and go, no, because of these little laws right here. You're probably already going to know it. But if they want a deduction, or if they know that they didn't make money, you go and file Schedule C. It's just like that. So it actually goes into a little bit of the parts. So again, if you end up hitting the plus sign, it may bring out something to show, maybe explain a little bit, but this is how the Schedule C EZ kind of goes. Now, this one actually only has 3 parts, so not too much to it. It's very straightforward. Part 1 is always going to be general information, so of course the book's not going to show it, and that just includes business name, address, and that's about it. Okay. Part 2 is your gross receipts, so how much money you actually came in. So this could include stuff that maybe on W-2 or 1099 miscellaneous. Your total expenses, again, notice that if you actually see it here, sorry I can't blow it up, but if you actually look at your book, you're going to notice that it actually tells you the $5,000 limit right there and says you must file Schedule C. So number 2 is very good, and then of course net profit right here. And I will tell you, every time that you look at a tax form or any of that, it's going to tell you exactly where to put stuff. I mean, tax forms are really good at that. They have instructions everywhere. But again, look, it'll give you one of the restrictions right there. So that's a good part of the EZ. One, nobody qualifies for it, but if you do try and qualify for it, it will warn you before that you're going to have to file. Okay? And the vehicle information is going to actually be part of Schedule C also, so that's where we're going to get into the vehicle info. But again, it's not extremely hard with the EZ. You just got to know the rules to it. Now, the Schedule C, as we're going through these figures, you're going to see certain things you have to actually put in. Okay? Now, one thing you're going to have is known as a professional activity code. And most software is going to allow that. Again, wish I could zoom in on this. Oh look. Listen to page read by read speaker. Let's see. No, large text doesn't do nothing. Alright. Well, when you look at this, probably copy and like paste the image, but you have to put in a business professional activity code. This allows the IRS to actually look and see if all these expenses are legit, or they're going to see if they're reasonable. Business have to do this just because the IRS does require this, and it just helps out in the end. This is also a big warning right here. IRS tends to love to audit based on these codes. So sometimes they just select random codes, and whoever has those, they can be selected for an audit. Doesn't mean you did anything wrong. It's just how it goes. They always want to do that checkup plan. Okay? So you will have to put these codes in. Again, it's going to have a code for a lot of businesses. This is only basically an excerpt. And of course, it doesn't have a plus sign. But when you're working like with Pro Series or TurboTax or any of those, TurboTax definitely will ask you what your business is, and they're going to find the code. Pro Series, you have to look for it. So that one's a little bit tougher on that. But you will have codes that you will have to put in. Man, okay. I'm going to change this up. Let's go to the IRS.gov site. So, if you go to the IRS.gov, you can find any of your basically forms. So, forms and instructions. So, you can look right here. And let's just put up Schedule C. So, Schedule C. Okay, so here's your Schedule C, because the book is, it's so small. So, this is Schedule C for 2018. So, let's go through this. First part of your Schedule C. This is your general information. Okay, so you're going to start with whatever name, basically the tax preparer name, whoever owns the business, and of course your social security number. Next is the principal business or profession. Okay, so what is the business? We have to put that in, and of course we'll have to enter in the code from the long list. Then we got the business name. If there is no business name, you just couldn't create one, just leave it blank. Most of the time this happens when it's just like a hobby or something like that. We don't have one. And of course, I mean, if it has a business, I will tell you this, always get an EIN. And those aren't hard to get. Just petition the IRS. And of course, your address. If it's your own address, you can just put in your own address. Doesn't really hurt nothing. And next, it's going to ask you what accounting method you're going to have. I'm going to tell you this, nobody picks 3. 3 doesn't work. Don't do that, because you're going to hit yourself for an audit very quick. It's only going to be 2 methods. 1, did you only record this stuff when you receive cash? Are you paid out cash? This usually goes for a lot of small businesses, and you'll end up doing that method. But if you decide that you have accounts receivable, you're tracking who owes you, and you want to put this in the income statement, you're more than welcome to do this also. Just remember this, you have to keep this method for years to come. Okay, cash, you can keep that method until you reach over, I believe it's like a little bit over $1 million. Then you would actually have to switch to accrual. But once you switch to accrual, that's it. You cannot switch back to cash. So as soon as you put accrual to the IRS, you need to stay that way. Okay, I'll be honest, it's a whole lot more complicated going from accrual to cash. Okay. Now it's going to ask, did you materially participate? If you actually were in the business and you did help, you want to click yes. If you didn't, you're going to have passive income. Okay, this is how it defines passive income right here. Okay, so again, passive income means it just a flow through, and you're limited on how much you can actually deduct. If you started or acquired the business in 2018, you kind of want to check that, because it allows them to know that you're probably going to have more deductions. This also comes in handy with the basically hobby loss that we're going to get into. Did you make payments in 2018 that require you to file forms 1099? That's basically if you had any contract labor, anything that would require 1099 to be issued, and did you file those required 1099s? So this is where people can actually shoot themselves in the foot. So you either say yes, yes, or no, no. Okay? Don't go yes, no. Because the IRS is going to look at you and it's like, why didn't you file? It's required. So that's one thing. Watch out for. Alright. Now, part 1 of the Schedule C. Part 1 deals with gross receipts. So whatever income we got in for the business, we're going to put in 1. If somehow you do have a W-2 with statutory employee box, that's when you're going to check that, and that money will also be included into 1. Any returns that you have, if you're a merchandise company, if you had returns, that is part 2. And of course, we're going to subtract line 1 from line 2 to get 3. So that would be your total income that you have. So our total income, then we take our cost of goods sold, which again is anything for merchandise or manufacturing. It's anything that relates to the cost of making that product or basically trying to get that inventory. Okay, so those you have to kind of watch out for. Again, if you've taken 2301 or 2302, you've gotten a little mix of cost of goods sold already, especially in 2302. 5, we subtract from line 3 and line 4 from line 3, and this is your gross profit. This is actually how much profit you've made before expenses, which is cool. Now, you may have some other income. This is where certain items will come in, and we're not going to go heavily deep into this one, but it's always good to actually research a little bit. But most of the time, you're not going to have too much of this. I'll tell you that. But this fuel tax credit and stuff like that, when it's mentioned that's mostly for commercial drivers anyway. So unless you're doing Uber or doing a bus, stuff like that, it's not going to be really effective. Part 2 is all your expenses. Lots of expenses. So it actually has a lot of lists of what's going on. Vehicle we're going to get into on transportation. Same thing with meals and travel and stuff. So we're going to get a little bit more specific into these in a little bit. But part 2 is a lot of our expenses, and it does list anything. And if you have a question on any of these that you're seeing right now, please leave a comment and I'll explain a little bit more if later in this video it does not get explained. But this is basically expenses. Now, with the IRS, this is something I like to show you. Sometimes their tax documents, they have a pending law or something that's going to go through the filter, and they'll end up putting these reserved for future use kind of things. That just means a law is maybe coming along that may actually change a little bit. So if I see that on a tax form, I may want to keep an eye on it for next year or so forth. It's not going to affect this year, but it's usually as we go. Alright, so after you complete this, put in all the expenses, you're going to end up seeing total expenses for, and of course it's before business use of home. Then we're going to have tentative profit or loss. So loss is basically our income minus our expenses. Then we end up putting our home office, which we're going to get into. That deduction gets in, and then we get our final net profit or loss, net income, net loss. This is going to affect what is known as self-employment, so we're going to also get into that. And then you're going to have to check this box, these boxes right here. This is trying to gauge the level of risk. Mostly, if it's just you as the business owner, it's going to be all investments at risk. And I'll tell you this, in any software, if there's a loss, you definitely going to have to check. Okay? Part 3 is all about cost of goods sold, which we're about to get into inventory. But mostly how we value the cost, we have a lot of other ways. Again, we don't hit other. Usually people go with exactly the cost of inventory. Lower of cost or market is one thing that we would have to figure out. Basically, we either take the cost that cost us or the fair value in the market, whichever is lower. That's how we value our inventory. But again, we're going to get into this in just a sec, especially with FIFO and LIFO. But of course, all you do is follow. So beginning inventory, purchases, any cost of labor. Again, do not include stuff that's for personal. Materials and supplies, other costs, and then we're going to find the inventory at the end of the year. If you're keeping good bookkeeping books, this is actually a really easy one. It's just going down the list. But they're going to have this question right here. I'm going to warn you on that question. Okay? When we get into FIFO and LIFO in a little bit, you can't really change the methods. If you change the methods, you have to get approval from the IRS to change these methods. Okay? So don't do, keep to one, stay that way. Part 4 is going to be on the vehicle itself. So if you have a vehicle that you're driving and it's for business purposes, this is going to be the basic info that's going to come from 4562, form 4562. Okay? But the basic info that comes through is, of course, when it started. So when did you place it in the service? It's going to ask you about miles. So business miles, how much was part of commuting, basically to and from work. F business, this is going to clients or anything else. And then of course other, if it doesn't fall into either one of those. Okay, and then it's going to have other questions if it was used for personal use, office, off-duty hours. Did y'all have another vehicle available for personal use? And can you show evidence? This is a mileage log. So you need a mileage log for all of that. Because it's going to go, is the evidence written? And you go, yes, yes, yes. Okay? So we're going to get into a little bit of the vehicle and when we get into the transportation part, but this is where the Schedule C has it. Okay? And then the last one, any other expenses that you do not see here, or you want to just get more specific, we'll end up going right here and we'll just keep listing until we list all the other expenses. Some businesses are like that. They're going to have very many complicated things. Okay? So we would have to list everything. Alright. So that's the basic rundown of the Schedule C. Again, if you go through the book, it goes through every part of it. Part 1, Part 2, Part 3, there's Part 4, and then Part 5. Okay, so the book does that actually pretty well, but I just didn't like it that it was so small. So this again is Schedule C. So again, first part, general information. Part 1, all about your income. Part 2 is all about expenses. Part 3, cost of goods sold. Part 4 and Part 5, vehicle and other expenses. Alright. So, reason why we have all this is that we're going to have to do self-employment tax. Ew. Okay. Taxpayers with net earnings of $400 or more are required to do self-employment tax. Basically file Schedule SE, self-employment. Now, self-employment tax is basically paying your Social Security and Medicare. Okay? So Social Security tax for y'all be 12.4% on the first $128,400. Plus, you have to do Medicare tax on all your earnings of 2.9. This is actually what, basically if you have a W-2, this is paying your half of Social Security and the employer's half of Social Security. So really what you see deducted on W-2 for Social Security and Medicare is only half of what you're actually getting put into your Social Security account, because the employer pays the other half. So, but when we're self-employed, we get to pay the whole amount. So, yay! Okay. Now, there's also another tax with this, and this goes with high income taxpayers. That's another 9.9%. So that may end up happening, but we're pretty much going to be fine right now. Taxpayers do get a deduction for AGI equal to half of the self-employment tax. So they try to help with this by giving you that deduction again. So you're paying the whole thing. So self-employment tax does go high, but you actually get half of it as a deduction, which works perfectly fine. Everybody loves that. They go, yay! So our book itself shows it right here. Again, basically, it's just another thing. And there's also a self-study problem. I would strongly encourage in these books, go to these books, do the self-study problems, because they just help. Okay? But this one's just trying to clarify, hey, do this, do that. See if it actually lets us fill out. It doesn't actually let us fill out, so you actually have to print these forms. But I mean, you can find the answer if you want to click the answer. I'm not going to go through this because there's this Schedule E, this one's all about just basically showing expenses. Okay? And of course, we haven't even gone through most of the stuff yet because we haven't really done the vehicle mileage. Because vehicle mileage, that's all times by certain things. So, fun stuff. Okay? Alright, so self-employment tax, if you do want to see what this form is, let's go check it out. So, let's go back to here, and you can go Schedule SE, and we just want to see it. So, here's self-employment tax. We're going to get into, again, more of this, but this is the basic form. So there's a short form and there's a long form. So this is basically going to be going through each of the steps. Again, we're going to focus on this a little bit later on, but most people will probably qualify for the short form, which is basically just do your income and times it by the percentage. So if it's more than 400, if it's less than 400, you don't owe any. So you don't have to fill out this unless you want to. That's up to you. But I mean, that's something we would get into. Alright. So inventory. Alright. Cost of goods sold for any retail business is a very big deduction, because this again is the merchandise of getting these items that you just sold. Now, the best way is LIFO and FIFO. There's other ways to do inventory. Again, if you took 2301 or 2302, you will see that. Again, and also check out the Accounting 2301 Chapter 5. That really goes into depth of LIFO and FIFO. But for our purposes, I'm not going to go too much into it. But basically, LIFO means last in, first out. So we take the cost of the last thing that we purchased, and that's going to be the first cost that goes out. FIFO is just the opposite. It takes whatever inventory we first got, and we use that cost as how much it cost us for cost of goods sold. For tax purposes, LIFO tends to be the one that's the best. Okay? It tends to be the one that helps reduce taxes. So if somebody's very keen on trying to get the less on tax, they're going to have LIFO as their inventory source. It must also, this is very important, has to be the financial statement purpose too. I cannot have LIFO for one and FIFO for the other. They have to be same for tax and for your books. So, under the law that has come out, if businesses with 25 million or less of gross sales, they are not required to keep inventory under accrual method. Inventory is an accrual item. It's not usually used in cash, so we don't have to worry about it too much. Cost of goods sold is an accrual item. But mostly, I would keep an inventory, especially once it goes. So you're probably not going to see too many inventories if you're in the small firms due to this law, which is actually pretty nice. Let's see if the book actually shows any info. Okay, cool. This actually has some examples. Alright, so again, there's a video that I go through, but here, this is a quick rundown. Okay, so Page made the following purchase of particular inventory during the current year. So we have all these. If the ending inventory is 60 units and it's valued under FIFO method as illustrated, we'll record this. So if it's 60 units under FIFO, we're going to take basically the first items that we've received and then issue those out. Now, with this, the first in apparently was December 1st, and wait, yeah, looks like December 1st. So that was our first ones. So they're the first ones out, and then we got, of course, August 1st. So okay, so this is actually completely wrong. I'm being honest on this one. Alright. The way that their dates are, they're off. Okay, so here we go. The way that they're trying to look at this is basically they have these switched. Okay, this is LIFO going on right here. This is FIFO. Okay, I don't know who did that, but they really messed that up, to be honest. Okay, so FIFO is first in, first out. So when we look at FIFO, we're going to start with March 1st because that's our first units that we bought at 120. And since we only have 60 units, okay, never mind. I see what's going on. They're just taking what 60 units we have left. Oh, I hate when they do that. Okay, so that's what they're doing. They're taking the units that we have left. Alright, so ending units are 60. Sorry for the confusion, because I was thinking that they're actually going through the steps, but they're not. So in reality, this is how it would gone. 60 units. First thing we were taking, or be the 50 units on the FIFO. That cost would go, and then we'll have 10 units out of the 40. So I don't know how they got 35 right there, because they're trying to do 60. I get that. Okay, so they're doing 60. Never mind. Alright, so 25 plus 35 is 60. So to them, the 25 units is completely left in FIFO method. Then they take the remaining of the 60 units in ending inventory and they take it from the 40. Okay, so that's where we got the 35. This, of course, is what's left in ending inventory. Again, if you go through the video in Accounting 2301, Chapter 5, I go through the whole process so you can see that process. This is where it kind of got me a little confused of how the book is trying to say it. But LIFO is the same way. All that's going to be left is, of course, the first batch of 50 units and 10 from the 40 units. Due to that, we only have 60 units left in inventory. So FIFO, what's going to be left is be inventory from here. LIFO, it's usually the top. Okay, that's ending inventory. I was thinking it was actually going to go through the steps to start off and showing you how we do the cost with purchases and stuff. My bad. Okay, but when we take the beginning inventory, especially if it's the first year, usually it's going to be 0. We're going to add in the purchases. Purchases are going to be the same for both methods. So this is going to be known as cost of goods available for sale. Now if there was a number here, we would add them together. Boom. A little bit bigger. And then we subtract ending inventory. For us, 8,050 is the ending inventory for FIFO. LIFO, it's 7,300. When we subtract these, it will give us a cost of goods sold. The higher cost of goods sold is, the more we save on taxes. So LIFO will show a higher cost of goods sold. Okay, about 750. So I mean, it's nice that they show an example. Again, I just don't like how they kind of just did the ending inventory. Wish they went through the whole process so you can see how LIFO and FIFO work. But again, definitely check that out as the video. So anyway, sorry about all that confusion. Alright, so again, if it's 25 million or less, we don't really have to keep an inventory. But I would always suggest, as true accountants, let's keep an inventory. It just helps out. Alright. Transportation. Alright. So this is our vehicle portion of this. So inventory. If you have questions, please give me some comments or questions. Again, I apologize for that little confusion. Just trying to understand also the book. So transportation itself, certain transportation expenses for business purposes are deducted, and this is basically going to be business miles. But again, we have an option with vehicles that we're going to get into. So let's start off. Taxpayers, they doesn't have to be away from the tax home to get transportation, but commuting is never deductible. And of course, when we say never deductible, IRS always brings in an exception. But traveling between home and work locations outside the metro area where a taxpayer has a regular place of business, those were actually considered to be deductible. Basically, like in construction, you go to your principal place and then you go out to your commute to these job locations. That can be deductible. Traveling between home and temporary work when taxpayer has regular place of business, again, job sites, temporary work sites, outside the metro area, outside the city. But travel when taxpayer's principal place of business is home. So if you have home office and that's your principal place, well, anywhere you travel to clients and all that, that's deductible. Plus, we can have additional costs of hauling tools and instruments, which is cool. We'll go with that. It's fun stuff. So this is all related to mileage. Okay. So cost of plane, rail, bus, and auto is also potential deductible. Usually we do kind of deduct if it's in reason. So again, if you're taking first class to meet with a client every week, that may not be reasonable. So Again, it's got to pass the test. But there's two ways, okay? One, with cars, we can take mileage. Mileage is usually the better of the two, but the other way is also just by expenses. So starting off with vehicles, the mileage rate right now is 0.545, so about 55 cents, just like 54.5 cents. So, but we do have a mileage rate. So this is part of the business portion. It's not, if it's not deductible, then we don't times it. Plus we get certain business items. One is parking, tolls, and personal property taxes. We actually get to deduct a lot of that, which is cool. And your auto loan interest if you're self-employed. So you actually get to deduct that. Awesome. Okay. But basically parking tolls is the number one. And especially here in Houston, we have a lot of parking and tolls. Okay. But to use the standard mile deduction, you must either own or lease that car. And you cannot have a fleet of vehicles or basically using 5 or more autos simultaneous. So a fleet, then it goes to expenses more than mileage. And you can't take any depreciation on it. I mean, it does say other than straight line, but you really can't depreciate a vehicle if you're taking mileage. Same thing is Section 179. Section 179 allows us to take the whole cost of a vehicle in the year that we bought it. Usually that's not a good option to do unless you're really hurting, but it basically kicks out the mileage. So you have to choose between the one and you have to stay with it. So again, we have actual expenses. This includes repairs, maintenance, buying tires, getting the vehicle ready, and depreciation. Once you choose actual, you can never go to standard. Standard, it does allow you to change to actual, but you must use straight line depreciation for the vehicle. I would never change from standard. That's my honest opinion on that. Usually the mileage is always going to be better, but that also depends on the business. So look at the business, and most CPAs or most accountants, tax accountants, they're going to give you both scenarios. This is how it looks with mileage. This is how it looks with actual. And 9 times out of 10, people are going to choose to take the mileage. Okay? So to calculate the deduction, multiply actual expenses by a business use percentage. Again, if it's not used completely for business, it's going to have a business use percentage. Basically, it's business miles divided by total miles. Okay, you have to times actual cost by that. So you still got to know your mileage, but you can go between the two. So really, again, that could be another blow to actual expenses, because you can only take the percentage that you use the vehicle for business. Okay. So again, here's some of the actual expenses. So gas, oil, repairs, maintenance, depreciation. Again, you can use personal property taxes and interest on car if self-employed. So two of those, these two, are used in both standard mileage and actual expenses. But I cannot use gas and that stuff in the standard. Business-related parking tolls are fully deductible. This is the only one that's not multiplied by that business use percentage. They will always be fully deductible. which is awesome. Usually we just separate this out and put that on the Schedule C, so you don't even have to worry about it. But with vehicles, they are fully deductible. Okay? So, reporting, taxpayers other than self-employed would actually have to carry this to Schedule A in Form 2106. So, you can have transportation deductions if you don't have a Schedule C. Still would have to put in Schedule A. So, and that will be a little bit more difficult to actually make it worth your while to actually do all the work. But if you got a small business and you got a vehicle like Uber and your tax account that's got to go to all these clients, all that jazz, vehicle is going to be fun. That's usually a big expense to most of your tax clients. So again, let's see if the book throws any examples. Always love it when the book throws some examples. So let's see. Again, it's explaining a lot that we just went over. Here's a little bit of the example that they're using. So let's see. Self-employed CPA. On Tuesday nights, he teaches an accounting class at the local university. Walter leaves his office at 5:30 on class day after dinner at a local cafeteria. He teaches the class at 7 to 10. Wow, that's a really late one. Then the distance from Walter's home to his office is 12 miles. The distance from his office to the university is 15 miles. And the distance from university is 18 hours. If Walter teaches the class 32 times a year, his mileage deduction is based on 480 miles. 32 times 15 miles. Okay? Because this 12 miles, that's commute. Okay? Also the same thing with 18 miles. That's going from university to his home. That's commuting miles. Okay? Those are not deductible, but the mileage that he has to take from his office to the university, that is deductible, because it's going to almost like a client to another off-site workplace that's related. Now, if Walter taught the class in the afternoon and returned to his regular job before going home, he could actually claim the deduction based on the round trip mileage. Because again, he's going to his principal place of work. His principal place is the office. Okay? So, and then as you can see here, this last line, if he taught the course on a Saturday, he will not be allowed to take any deduction, because then that's commuting to the university. The university is now his principal place. Okay, so mileage is a fun item if you can look at it. It has a bunch of stuff with knowing your actual mileage log, and the IRS is going to look at that. If you don't have a mileage log, IRS does give time to actually produce one, but man, you gotta prove this a lot. So here again, it's another example. TJ drove his automobile 22,500 total mileage during 2018. Business use of the automotive was 80% of total miles driven. The actual cost of gasoline and stuff during the year was 10 grand. So under the standard mileage, his business mileage is basically 22,500 times 80% is about 18,000 miles. Again, about 54.5 cents per mile will be about 99,810. Under the actual cost method, we get to take all these, but that's only 10 grand times the 80% of actual business use. It's only 8 grand. As you can see, standard is beating out actual. Okay, usually they're going to want to take the standard. It's the bigger one, and it's always going to be that way in the years. Some days, some years you may have lots of repairs, but eventually in the grand scheme of things, it's going to be more to the mileage. So, I like this. The would you believe? The IRS has been battling fraudulent tax returns filing using prisoner taxpayer identification numbers for over a decade. Wow. So, it peaked in 2012, but fraud happens a lot with taxes. We are, as tax accountants, we are looked at a lot because there's so much fraud that happens since there's so many rules. Well, this is dealing with prisoners, man. They're not even driving. Oh, they don't have a say. That's wrong. Okay, next one, dealing with travel expenses. So travel expenses is another one that we have to watch out for, and they do have to be ordinary and necessary. Like I said before, with transportation, with the planes and the trains and buses, they have to be ordinary and necessary, and they have to be sustained and not lavish. Okay, we can't go to a penthouse as an overnight stay in a hotel and say that's they have to be ordinary. Okay, so travel status requires being away from home overnight, and that basically just really defines as something long enough to need relief from work. So being in a hotel room, doing something, doesn't mean 24 hours. People think it's gotta be 24 hours. It's not. It's just basically enough of a break. Okay. So it does need to be away from tax home to be travel status. You can't take travel expenses to your house. Doesn't work. So tax home is the primary place of business. It is not necessarily the same as a family residence, but still, you can't take travel expenses to your home. Okay, so it has to be away from the primary place of business. Okay, so we can take travel, we can take hotels, all that. So expenses include any kind of lodging, taxis, Uber, Lyft, laundry, if we actually have to pay a fee for laundry while we're traveling, any tips, and meals. Now, meals is another one that you have to watch out for. Meals are always only deductible by 50%. You can only take 50% of your meals as a deduction. Same thing with entertainment. But if the employer reimburses your meals, the 50% limitation still applies, but only the employer can only deduct 50% also. So you can still do the deduction, but basically it's going to be a wash. I would always put the deduction there. If they're reimbursing you, put it there on the tax return, so it basically cancels out that added income that's showing up on whatever W-2. Okay? If you can deduct it, deduct it. It's always fun stuff. So, expenses of temporary assignments are deductible if not practical to return home each night. So, again, that's if you're going to a hotel room. Okay, if you're going back to your home and to the place, again, they're not going to really take too much of that. So again, more commuting. Long-term temporary assignments, generally over 1 year, they may actually be reclassified as a principal place for the taxpayer. Okay. Again, always keep records. When we're tax accountants, you always tell them, simple. You must prove this to the IRS. If you cannot prove it to the IRS, do not take it. Okay? So, to deductible on dependent, where travel occurred and where trip is classified as business, pleasure, or a combination. If it's primarily a business trip in the U.S., all travel costs are deductible. Okay, travel expense is split up between business and personal. So again, the travel costs to and from are deductible. Any expenses that happen during the trip, you have to actually separate them out. Okay? If the primary business is outside the U.S., travel costs are split between business and personal based on number of days. Okay? We actually have to do the math on that one. It's fun stuff, but mostly if they're not going outside the U.S., it helps out. Other travel costs are deductible if associated only with the business. Okay? Common sense there. Keep it for business. If it's a pleasure trip, in or outside, it is not deductible. Okay? Now, if somehow you do deduct, can do some business, the meals, lodging, transportation, if they happen to be, you end up doing some business, then you can separate the two. I would say this: if the trip's for pleasure, just don't even mess with it. Always use the business trips. So, let's see. So again, the book does go through a lot of the travel expenses and does give examples. And this is the per diem. Okay, so per diem is probably coming up. So on your PowerPoints, we do have the example also. So Gretchen, a director, travels from Idaho to New Mexico for business. So they're in the U.S., so they're paying $380 for airfare. She then spends $330 on lodging and $150 on meals for the business portion. While there, she goes on a personal sightseeing tour of Turquoise Trail and spends about $400 on car rental and lodging and $85 on meals. What can she deduct? Alright, since it was in the U.S., the airfare is deductible. We can deduct the whole $380. Of the lodging of $330, we can deduct, okay? But we can only deduct 50% of the business meals. That's also deductible. All this stuff that she does on her own for personal use is not. So even though she spent $85 on meals, that was for personal. That was for that little special trip. Okay? So her total deductions is going to be the $380 plus the lodging plus half of the $150. Okay? So per diem. Per diem. This is, of course, ways that the employer actually reimburses. So we actually may have this, and it may actually pop up on 1099. There are certain ways that we do these. So one is the federal rate, and it is specified per day. Basically, it's based on travel locations, and it's going to be updated regularly on the U.S. General Service Administration website. So we can always check to see what the regular rate is. This is how much employers will get to reimburse you. Then you have the high-low method. Okay? It's really easy if employees do travel a lot, travel salesmen, stuff like that. A few high areas are specified by the IRS. The IRS actually says this is how much you get to pay. So like New York City and stuff like that, it'll be about $284 per day. Low areas, like a small town or stuff like that, you may get $191 per day. But once the method is chose, it must be continued throughout the year. You can't change these up. Okay? Basically, per diem just eliminates any necessity of keeping receipts and stuff like that. And rates are split into meals, only, again, 50% deductible, and lodging. Okay? Then you have the meal and incidental expense method. This allows per diem for meals and entertainment, but it also allows for actual lodging, so you don't have just a rate for meals and lodging like the other two. So you can take the high-low rates, again 68 or 57, depending on how the IRS defines where you're going. If taxpayer doesn't incur meals expenses when traveling, you allow basically an entertainment fee of about $5 a day. Okay. Notice this, they're also basically revised every October 1st. So, and sometimes the IRS may actually have to go multiple times. So, again, all these methods are right here. That was just the explanation real quick of what's going on. Okay. So, again, go through these self-study problems. It helps. Okay. So, entertainment. So, prior to our law, there was a deduction for 50% of cost of entertainment costs connected to trade or business. But now it's changed. Okay. So, costs associated with entertainment, amusement, or recreation, membership, dues to a club, or cost of a facility used in connection with any of the above is no longer deductible. This is kind of a little blow, but it's not too bad. But remember this is only for 2018. If you have someone filing for 2017, they get to still use entertainment. We have lost it. It's one of the things that has changed with Schedule C. So anything dealing with entertaining, amusement, or recreation, membership dues to clubs are no longer there. They are gone. Okay? Education expenses. So this is actually a very complex area. So I like how they actually have the note right here. This is something that you actually would have to read the law, and it does get a lot of complications right here. The book is mostly going to deal with continuing education expenses that are incurred by taxpayers. Other stuff, you're going to deal with basically putting that into your actual 1098-T, which is student loans and stuff like that. So qualified tuition programs, savings account, tax credits, and loan interest. There are discussed other areas in your tax return. Schedule C really just only goes with continuing education. So of course, what is deductible? Cost of the course, lodging costs, again 50% meals and travel. Okay, if the primary is to obtain qualified education. So this is stuff that we actually have to continue, maybe do another course, stuff like that. They must be paid to meet requirements of taxpayers' employer or comply with laws and regulations. Okay, so if the employer requires you to go and get your degree or something like that, you may actually get to deduct it on the Schedule C if you get issued a 1099. Other places is itemized. Okay, for tax accountants, service people that have laws that change and all that, we actually have to maintain and improve our skills. So if we're running our own business, we get to deduct these as we go. Things that we have to watch out for: that education cannot lead to qualification in a new trade or business. Okay, and it also has to deduct if minimum requirements, if it requires to meet just the minimum requirements for current job, have to go above and beyond with education. Okay, that's a little bit more of a tricky one. And again, you can go to the book. This one, know this stuff. So we do have an example. We have Roberta. She is a paralegal, goes to law school at night. Her education, so we're going to find if her education expenses are deductible. So Roberta flies from her home in El Paso to continue her education conference. for paralegals in Dallas. If 30 hours per year of continuing education is required for paralegals to maintain their certification in Texas. Okay, so again, this is maintaining. If the first scenario, the cost of attending law school are non-deductible because the education would qualify her for a new trade or business as an attorney. Okay, so this little part right here, you also have to watch out how the laws go. Paralegal and attorney, two different things. Paralegals, of course, are the beginning parts. They're the secretaries. But if you're going to law school at night, you are going for a new trade or business. And again, as an attorney. So as accountants, we got no business like crazy. We research a lot. So one, we protect our clients as much as we can. In the second scenario, this flying from El Paso to continue education, this would be deductible. Meals and entertainment at 50% only, of course, but since it's still requiring to maintain her existing job, because we are supposed to maintain a certification in these professional jobs, those are required. But again, if it's going for a new trade or business, no dice. Whew. We're getting there, okay? I know this video is getting long, but we are getting there. So, dues are basically any professional engage in practice will have dues, subscription, and publications. We will have to order, okay? We'll have to pay dues to certain organizations. Those are going to be deductible, okay? Technical journals, dues to professional associations, those are required in this category. That's basically it for this one. So, they're mostly going to be for professionals, okay? Not everybody gets to subtract the magazine to life, but if it's a technical journal, we do get to basically deduct. So this is really for professionals only. Oh, I don't even know why they brought this, but special clothing and uniforms. Uniforms and special clothing are deductible if they are a condition of employment and can be worn outside of work. So if you're buying t-shirts and pants and work boots, and they're going, t-shirts and pants, of course, you can wear them anywhere. They're not required. Work boots, that's a little tricky. You may have to be required to wear a steel-toe boot in certain jobs, and you don't really wear that outside of work, then it can be deductible. Mostly uniforms are going to have somebody's name on it, stuff that you have to buy. Cost of laundering and altering of uniforms is deductible as long as it's related to uniforms. Suit don't count it, okay? If you're a professional, you are required to wear a suit, but of course you can wear that outside of work. So again, this is a tricky one. Gifts. Okay, so gifts have certain limitations. Again, we may deduct gifts up to $25 per donee, basically donor, per year. This includes donee, so whoever given it to, cost of wrapping and shipping. Husband and wife does equal to one donee, unless both are clients, then we actually have to separate. No limitation for small business gifts up to $4 each. Okay, so if you keep giving $4, you're pretty much good. If taxpayer or company's name imprinting on them. So mostly those pens and pencils and little things you get like at those conventions, completely deductible. They probably weren't deducted under gifts, probably under supplies. Usually how it goes. Deductions for tangible non-cash personal property is up to 400% allowed. Up to 1,600 is allowed if it's conjunction with a qualified plan. Now, qualified plans again are certain things in the law that we are allowed to basically combine, which we do love, but mostly we're going to keep it to the 400 is allowed. Gifts to taxpayer supervisors are not deductible. give a gift to any coworkers or stuff like that. They have to be clients. So bad debts, as we still got a little bit. Bad debts arise when basically when we sell and we realize that they're not going to pay us. Okay? Cash payers cannot deduct bad debts. This is only for accrual people. Okay? So, when you have accruals, you are allowed to deduct bad debts. And it's only allowed up to the amount previously included in income. So again, it's all about accrual base. And it must be used specifically in the charge-off method. And the IRS is going to require proof of the worthlessness. So if you have a bad debt, you're going to have to prove that this person is not going to pay. So mostly, again, this is only for accrual people. It's not for cash. Now, there is two categories of bad debt. One is business bad debt, and these are ordinary deductions, and those arise from trade and business. Okay. Other one is non-business bad debts, are basically short-term capital losses. This is where we get into Schedule D, which of course we're going to get into a little bit in Chapter 4, because this is another passive income. So this is us giving out a small loan to somebody, and they actually did not pay it back. So we're going to have it mostly on the Schedule D. So again, here's an example. We have Kiko, loans a friend Lars, $20,000 to start an upholstery business. Lars cannot repay Kiko. Is the business for a non-business bad debt, or how much may Kiko deduct in the current year? This is a loan to a personal friend. So this is a non-business bad debt. So this is going to show on Schedule D as a short-term capital loss. So she will not be able to deduct the $20,000, only $3,000 for each year, but she gets to carry this year to year to year. So awesome stuff. Okay. So let's get into the big bad people. Okay. First off, office and home. Okay. Now the book does reference all this stuff again, so I would definitely just check out the book. Won't take long to actually read, but always go over. And especially the would you believe. I like the would you believes. Those are good. Here's our business gifts and situation requirements. Try and do the study problem. That actually works out. Okay. Bad debts. Here they are. And office in the home. Now, definitely read these because there is income limitations. I'll always say that. And we're going to get into all of these little methods real quick. But just showing what's left in the book. So, lots of fun stuff. Okay? And all your key terms. Key terms, yay! Okay, so let's get this done. Let's start off with the home office. Now, you are able to deduct business use of your home, but the IRS does regulate this. They have to meet certain requirements. So one is that the place that you're using, the home has to be regularly and exclusively as a principal place of business, or it's required as a convenience to the employer when regular offices are not provided. So anything of those work at home based places, those can be used as home office. Again, a lot of the convenience. Jobs mostly online, we're good. The regular place to manage business or meet with clients / patients. So that can also help you qualify for a home office. The office is a separate structure and used exclusively for a business. Okay? No pleasure. Okay? Can't have that. Has to be exclusive for business. Dwelling unit is used for inventory storage. So you're actually storing inventory for your business. and the home has to be the sole place of business. Can't have where you're just storing for the employer. Has to be your primary source. Okay, those are starting out. Deduction cannot be used to create a net loss for the business. Okay, so if the home office is going to basically create a loss, they're not going to do it. Okay, programs won't do it. You're not allowed to. The only exception is, of course, if it's allowed, because it's basically allocated versions of mortgage interest and property taxes, because those are generally tax deductible anyway, but the home office cannot actually lead to an actual loss. Okay, costs that you can actually include into to be allocated are rent, home insurance, any association dues, repairs, cleaning, gardening, and depreciation on the cost of the home. Any excess can be carried forward to future years. So it is true that if it cannot be recorded for a loss, it may end up being pushed into next year. We have to watch out for home offices. Again, the major rule with these is that it has to be exclusive for business. So when we do these allocations, it is done basically based on square footage. So it's going to be home office square footage divided by total home office square footage. Okay. When we look at the form 8829, so again, if I go form 8829, so again, if you ever want to just see these forms, go to the IRS and look them up. It's not hard, but this is the home office. So it is separated out into two columns right here. This is where the book is trying to talk to you about. There's certain expenses that are directly related, and a lot of times they're going to be indirect. Okay. So when we're doing direct is work done directly on home office. So basically it's any improvements to the home office itself. Indirect is everything that can be allocated. Okay, so we're going to take the cost of that, times it by this percentage, and that'll be how much the home office gets. So now there is a simplified method, and basically it just allows the taxpayer to take $5 square foot that may be taken as the deduction with a maximum of $1,500, and it may not be carried forward. So some people go simplified. I'd rather do it this way. Reason why is that you may actually get a bigger deduction right here. So again, it's all up to what your client wants. You can do both. I normally go with the deduction. Okay. So again, here's it going about expenses for business use of your home. So this is mostly going up here, down here. Okay, here's the carryover. Hey, carryover. Alright. So again, right here we're dealing with expenses of your home. Okay, so expenses for the business use of your home. If you're self-employed, the deduction carries from 8829 to the bottom of Schedule C. Okay, if you're taking as employee business expense, this is only on Schedule A. Okay, but again, this is only if it's necessary for employee convenience. An employer does not provide a regular office. So self-employed, we get this form. If it's other than self-employed, it drops to Schedule A. So again, home office is that way. For this chapter, we're mostly just dealing with Schedule C. So here's our example. Kitty, a part-time cartographer, maintains her office in her home. She does coordinate certain projects and keeps client records. She allocates $12,000 in mortgage interest and taxes to her OIH and collects $11,000 in fees. Assuming no other business expense with her current is deducted, how would this change if she was allowed to allocate $2,500 in maintenance and utilities? Will she have a carry forward? She's not going to use the simplified. So, I always love it when they give us two of the same PowerPoint. So the solution with this, in our first example, which basically is all about the mortgage interest, she may deduct the entire $12,000 with no loss carried forward. Because it's mortgage interest, this is already deducted. In the second scenario, about the utilities, she will not be able to deduct the additional $2,500 as she is limited to the gross income derived from the trade of business. Because right now she does have the mortgage interest. That expense is higher than the fees that she got. She actually has a loss right now of $1,000. So with that, she can carry forward the $2,500 that she basically allocated to the home office, and that gets to be carried forward. Okay, so fun stuff. Alright, last little parts. The whole hobby loss. Okay, hobbies and business. This is a very, very difficult little thing here. Okay, hobbies like building stuff on Etsy, stuff that can be truly put as a hobby, you have to watch out for. Okay, hobby losses, they are limited to the profit made. Okay, they are basically not engaged in a profit motive. Okay, we're going to see this in just a sec. But if you're not basically in it to make a profit, you can only deduct hobby expenses up to the income that you receive for that hobby. If you're not going to treat it as a business, do it that way. Okay? Hobby income must also be included as other income, line 21 on Schedule 1 of Form 1040. Okay? So, it does show there, but this is the thing. This is the hobby loss rule. Taxpayers do avoid this rule if they can show that the activity was conducted in the intent to earn a profit. Okay? To them, the taxpayer can show profit in 3 out of prior 5 years, or 2 out of 7 years if the business is involved with horses. Horses, yeah, you get a little extra, but 3 out of 5 years, you must show a profit or show that you're attempting that way. Okay, but they actually do want to see a profit. If you don't have profit in 3 of those 5 years, you may be dinged for an audit, or the IRS is going to say, you're not in this for a profit, you're not in this, so we're going to reduce the deductions that you have, that net loss, to your income, which can mess you up a lot, okay, in a way that you could actually be owing tax then and then have to pay penalties and interest. So you want to have it to that factor. So factors to help determine the profit motive. These you need to help combat the IRS in case they try to reduce this. 1, if the activity is conducted as a business. Okay, so if it's conducted as a business, there's a profit motive. The skill level and the expertise of you. So of course, if you're doing it on Etsy, that's pretty much good. The amount of time and effort expended. So you're actually putting the time to make it a profit. Previous success of the taxpayer in similar activities. Income and loss history from the activity itself. Relationship of income to losses in the activity. So IRS looks at all of this. If you can start proving these, it really helps you in case you cannot make that rule of 3 out of the 5 years as a profit. It's also going to look at the financial status of the taxpayer and elements of personal reaction in the activity. So basically, your attempt to avoid hobby losses and getting dinged, make sure you just make it as a business, run it like a business, have that profit goal. If you don't have a profit goal, just go ahead and just take your expenses up to your income. Do not take a loss. Okay? So that's it for chapter 3. I know this was a little bit long in the video itself, but there's a lot that goes with Schedule C. So if you have any questions, please put in the comments below. I look forward to reading those, and if you want to email me, you're more than fine to email me, and I will see you for the next chapter in federal individual tax to learn more skills as we go on. Okay? Y'all have a good one. We'll see you later.